Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Hey, Warden, welcome to this episode of the podcast, mate. How you going?
I'm really good. Owen, how's things?
Good, mate. Very good. Yeah, it's a bit dreary down here in Melbourne at the moment. How's the weather up north? How's Queensland looking, mate?
Warm. Yeah, we did. I think we had 6 solid days and nights of rain on Sunshine Coast, which you do sometimes get when the summer finishes and you go into the cooler months and you get that transition. But it's pretty nice now. So, but yeah, a lot of the golf courses and sports fields are saturated. So, yeah, we took a lot of rain over a week. But yeah, it's pretty nice now.
Good time. Good times to spend inside and crunching some data on financial markets, which is what we're going to do
if
today.
You say so, yeah.
we're going to do hopefully this start of a new series within the shows, which is state of the markets, and basically the purpose of this is to give people a view of what's transpired over a more considerable amount of time, in this case a few months, and allow us to cut through the noise to some of the real data points that everyone wants to know if they're building wealth in property, outside of property, across both property, shares, businesses, whatever. We're going to try and pick the brain of the mighty Pete Wargent for a moment and bring some data to life. And so we'll spend a bit of time covering property as a whole. Then we'll move into more economic indicators, and finally we'll conclude with the more stock market and bond market side of things as well. So maybe we can start with residential property, Pete. The quarter that was, we've got some CoreLogic data here, which shows that nationally prices rose 1.6% for the quarter to 31 March 2024. But within that, there's markets within markets, as we say. How are you thinking about Australian residential property so far in 2024?
Right. So the first quarter, 1.6% increase. As you said, so these indexes are actually weighted towards Sydney and Melbourne being the largest market. Sydney, 0.9% increase, and that market is up 9.6% over the year. So very strong. Now, Melbourne is interesting because quarterly it was actually slightly negative. I think this is big picture stuff, 0% or minus 0.2% is, there's nothing in that really. But it's interesting. The Melbourne market has been much flatter over the past year, only 3% growth. So if you compare that to some of the markets that are really booming, like Perth is up 20% over the year and still going at that kind of pace in 2024. Brisbane and Adelaide still very robust growth, I suppose, 3% or so over the first quarter. So yeah, there's different markets. Hobart, Canberra, and Darwin, to some extent, those markets are much softer at the moment. So there's always, as you said, markets within markets and cycles. And at the moment, the sun is shining on Perth in particular. It's a boom phase of the cycle. Melbourne is much quieter at the moment, and there are various reasons for that. Partly land taxes and just some sort of anti-landlord sort of sentiment down there at the moment, but those things tend to go round in a cycle, and Melbourne's time will come again, I'm sure.
Let's just double click on Perth there, Pete. 5.6% up for the quarter.
Booming, yeah.
Booming. Yeah, that's huge. And 20% for the year. What do you put that down to?
It's a cycle thing. I mean, so Perth is, and Western Australia in general, very much driven by the resources cycle. So I don't know exactly, but if you went from, say, 2003 to 2011 or 12, prices maybe tripled over a very short period of time. But then we basically had a decade of nothing for Perth, and there was a big overhang of properties in the previous cycle. There was vacancy rates of above 5% for a period of time, and it took a long time for all that to be absorbed, but also for confidence to come back. But now with the resources cycle moving on, we've almost got like an echo boom of the resources construction boom that we saw through the resources go years. And now we're seeing sort of reinvestment to extend some of those projects and reserves. Also base metals this time around. So if you look at interstate migration, there's an old saying in real estate, find out whether people are moving and buy the land before they get there. Well, interstate, people are moving mostly to Southeast Queensland, but particularly now, or notably, Western Australia. So the population growth on a percentage basis in Western Australia is very high. It's back to the boom time years, well above 3%. So there's a cycle element. 10 years of underinvestment in housing and now chronically tight rental markets. And as the market is wont to do over there, it's absolutely flying. I read somewhere that something like half of properties are selling before the first open or something like that. It's just, it's interesting because there used to be these pommy TV shows, like a relocation to, I can't remember the exact name of the show, but it was like people moving to Australia. And it was, they were set around 2010, 2011, and there'd be 35 buyers for every property. And it was just crazy stuff. But we're back in that phase of the cycle for Perth. Haven't seen that in Sydney and Melbourne for quite a while, but it's basically a frenzy or a mania phase.
Do you think a lot of people, I speak to a lot of people about this. We have obviously investors and members all across the country, but a lot of them are looking outside of Sydney in particular because of affordability issues. They may have hybrid working style jobs or online jobs where they can do those things interstate. Do you see, do you factor that in how you think about that interstate migration?
It is happening, yeah. I think part of it as well is that a lot of people got burned buying off-the-plan units and apartments in the previous cycle. It can be a bit of a roulette thing as well if you're buying a new off-the-plan apartment. I mean, who knows? You might have defects to deal with or other sort of construction issues. So I think people are leaning towards established properties or houses, which takes you outside of Sydney just from an affordability perspective, because even just buying a two-bedroom red brick apartment in Bondi Beach or Coogee, you're looking at I think very expensive now, mid ones or something, where you could go to another part of the country and that would easily buy you a house, and in some areas, very nice house. So I think, yes, affordability has driven some investors away. And I think, certainly through COVID and the pandemic period, more people were looking for houses more so than units. People wanted space. I think people are more sort of inclined to look at regional markets these days as well because of remote work and the move away from the office.
It's definitely something that I'm seeing more of. I've been speaking to some academics who moved to Perth, were able to do their job from there and these types of things. So how about in terms of something that you and Amy spoke about on the Australian Property Podcast recently, spoke about commercial property? We've had a lot of people interested. I know you mentioned, we didn't really touch on it too much there, but Melbourne in particular with land taxes and Victoria, that's really having an impact on everyone that I speak to down here, significant impact. A lot of people are thinking, well, maybe I can get some yield from commercial property. Maybe there are other things, expand my horizon beyond just residential property. There aren't too, as we were just discussing off air, there aren't too many data packs or, indices that we can track very closely and provide a concise update. So it's more anecdotal, but how do you think about commercial property so far in 2024?
Yeah, it's very hard to track, but partly because it's such a massive asset class. So Amy and I talked on the podcast about how commercial property, under that umbrella, you've got farmland, office towers, retail centres, medical centres, sheds, warehouses. It's just such a wide range of assets that come under that one catch-all term. So there's no easy index to look at. Now, office space is really in focus at the moment because of the aforementioned move to remote work or using service offices and things like that. And we saw even this week, so 255 George Street, which is an A-grade office tower, that's like the pinnacle really for, commercial real estate. Well, reselling for a 17% discount. So you can do the maths on that. If an A-grade office tower has lost that much of its valuation in a relatively short space of time, you can imagine a lot of these sort of B and C grade office spaces, there's no buyers for that stuff. Rents are down in the office space, valuations are way down and falling. So there's parts of the commercial market that are really struggling and probably have a period of pain ahead until that rebalances. But there's other parts of the commercial market that are really strong, mainly industrial space in particular. So warehousing, in some of the sort of peri-urban locations within a couple of hours of the capital cities. That's really strong. Lots of demand there. I think as well, if you just take a sort of zoom out and take a bigger picture look, I mean, where's the demand going to be? Things like medical centres. We've got a growing and aging population. There'll be no shortage of demand for those. Childcare centres, that kind of thing. So I think it's a bit more of a niche asset class. I think retail is another sector which is, it's a bit fickle at the moment because there's a big move to online shopping, of course. But then certain types of retail are doing well. So you really need to sort of know what you're planning to do. Because as you mentioned, the yields could be very good. You could get 6 to 8% net potentially on a commercial investment. But if you don't get the right type of property, you could have a vacancy period, or you might not experience capital growth. And there's more risks to be managed, I suppose, in that asset class.
Yeah. Yeah. And, we talk about, Melbourne, Sydney, Brisbane in resi, and then we talk about commercial property. It is markets within markets, and there's assets within those markets. So we're not necessarily saying good or bad. It's more so, you've got to do your due diligence and find the assets that fit your strategy. We were just talking off air, maybe before we move on to the economic indicators bit, we were just talking off air about, I was just asking you about how you think about residential property as a vehicle for passive income, because even just this morning I was chatting to a fellow I know down the street, and he's got 2 investment properties, smaller properties in semi-regional areas, and he's selling one of them. He's just sick of the land tax here in Victoria and all the stuff that's going on, and he's just fed up. So he's selling, and he's looking to secure passive income. You've spoken about this previously, where you suggest that maybe residential property has been good for quite a while in terms of producing capital growth for people, especially once leverage is included. But in terms of passive income and getting that actual real yield that hits your bank account every single month or quarter or whatever, how do you think about that in terms of the asset mix that someone might have and how they sustain a lifestyle?
Yeah, short answer is I don't really. It's just not a very good vehicle for passive income, realistically. I think periodically people have gone to, actually, I'd say, yeah, that's mostly true. It's not completely true. There are parts of the residential market where I do know people making very good yields, 15%, for example. But it's not just a suburban house. That's usually where you've got things like, in Britain, HMOs are popular, where you're renting out the house by the room, for example. Or if you do a very high quality Airbnb, there's different ways you can generate yield. But if you've just got a standard property, it's just not a very good vehicle for a whole range of reasons. You've got property management costs, insurances. You mentioned land taxes on some properties, repairs and maintenance. There's always things that come up, and it's taxable income. If you think about, in Australia, we've got dividends, imputation, franking credits. The tax system is very favourable if you want a passive income from the stock market, but not so much for residential property. I'm not can be done. It definitely can, but it's usually more niche property types that are more akin really to a commercial type of investment, much more so than just a standard residential property. You only need to look at the yields. For Melbourne on houses, it might be 3%. If you go elsewhere, it might be 4.5. But then you've got to take off the costs. Doesn't really work from a passive income point of view, unless you're going to engineer the yield in some way, which might mean short stay accommodation, renting by the room, Airbnb, that kind of thing. So yeah, I think there's better vehicles realistically if you're looking to generate passive income.
I've noticed I've spoken to a few investors, particularly in Brisbane, actually, your brethren up there, who are looking at doing those kinds of dwellings where you can have multiple tenants effectively in the same house. And it seems to be a strategy for passive income, still quite niche as far as I'm aware, but seems to be working for folks that are willing to go to that extent.
Yeah, you've got to think as well about the resale, because, quite popular for a period was people building these sort of 2 income properties, dual income properties, but on one title. And then you've got almost like a duplex, but you've got two front doors and you get 2 tenants. But then who are you going to sell to? You're not selling that property to a family. You can only really sell it to another investor. So Yeah, I mean, it can work definitely from a passive income point of view, but it's a little bit more niche. So yeah,
Yeah.
there's a place for it, but yeah, the people I've seen who've done it most successfully are really looking at it from either a house of multiple occupancy or doing things where it's short stay accommodation, maybe for a week or a month or something like that. And then at each new tenancy, the property is being restored to a high quality again, and yeah, on to the next tenancy. But there's a bit more work involved in that too, of course.
Yeah, is it truly passive if you're spending a lot of time just thinking about it and managing people and
More like a business. Yeah, you're
yeah,
right.
yeah,
Instead of passive, like, an investment in an index fund or a listed investment company, there's nothing to do. You just literally buy it, and it is passive. So yeah, I suppose it depends on your definition of what's passive income.
true that. For folks who don't know too, Pete is a buyer's agent in and around Brisbane, but also a property coach. So you can find out more about that by following the link in your podcast player if you want to learn more about the strategies that he puts in place. And you can chat with him one-on-one. But now we might zoom right out and just look at some of the economic indicators, Pete. Inflation, we'll tackle that through two lenses. We can look at the US, we can look at Australia. We'll look at the interest rates in Australia and maybe even just have a quick look at the US and what the forward yield curve. I know that sounds pretty scary to a lot of folks, but we'll explain what that means in a second. But basically, the two economic indicators that everyone likes to follow, Pete, are inflation and interest rates. For multiple reasons, interest rates are the handbrakes or the accelerator or both, depending on who you trust. And inflation is what we're trying to get back in the bottle. Do you think that like inflation in in the US, 3.2% in February 2024, monthly indicator in Australia, 3.4%. Do you think that we are taming that beast, so to speak? Are we getting inflation under control?
Yeah, different ways of looking at it. Yes, in the sense that year on year, inflation is pretty close to where it needs to be. Australia has a different target from a lot of other countries, 2 to 3%.
Yeah.
The official quarterly figures are 4.1. You mentioned there's now a monthly indicator, which is a bit lower. So we're not far away from the 3% target. I guess the challenge really, and yes, the US has a 2% target. It seems to be that last mile might be difficult. We've got inflation down from the 7-8 kind of readings that were caused by the lockdowns and the supply chain disruptions, and we're back towards something close to target. But getting right that final leg of the journey might need some extra work. It's
The
just being
80-20 rule.
yeah. It's been the easy or the low hanging fruit's been taken, and yes, year on year the figures look better. But I think if you when you only have to go and eat out, you can see what's happened to prices since 2020 for food and fuel and things like that. It's way higher. Wouldn't be unusual to see stuff that's 50% more expensive, and that's really hurting people at the lower end of the income quintiles. Because the necessities, things like food and rent and things like that, have really spiked. So yes, the central bank can say, hey, look, the inflation figures are now 3 to 4%, and we're winning that battle, but they haven't quite finished the job yet. And that's why when you look at the interest rate pricing that you mentioned, yes, banks are starting to think about cutting interest rates, but they're not going to rush to it, because the last thing they want to do is let inflation expectations accelerate away again. So they need to show some credibility and commitment to getting inflation back to target.
One of the things that then obviously marries with that is interest rates, and the Aussie rate is 4.35, the US 5.5 for those of you that are playing along at home. So effectively, this has broader implications for investment portfolios, which we'll come to towards the end of the show, and how you can use that to your advantage. But effectively, we haven't had any change for a little while now, Pete. And it seems like if people always talk about this neutral rate, this rate which is kind of the rate which interest rates must be to have a stable economy, we seem to be at a point where we don't have that kind of shock and awe every first Tuesday of the month for the RBA, for example, where we're all like waiting with bated breath, thinking what's going to happen today kind of thing. It seems like we've reached some point of stability. Some people might say that's the top. Some people might say it's the middle. Some people might say, we've got more to do. How do you think about kind of what we've seen in the first quarter insofar as do you, tying onto that inflation, those inflation monthly readings coming down, but there's obviously implications more broadly. Do you think that maybe we have done the most of the heavy lifting there in terms of interest rates? Maybe there's a bit of other things that need to take place in terms of maybe fiscal policy, like government policy needs to do some of the work from here?
I think, yes, we have done most of the heavy lifting. I think if you look at market pricing for the next 6, 12, 18 months, well, markets are expecting interest rates to come down maybe a few times, I guess, over the next 18 months. I think you mentioned a really interesting concept there. That was the neutral rate. I think it's fair to say the current setting is restrictive. So things like household consumption, that's slowing, retail volumes are well down, dwelling approvals are a decade low. So we're in a restrictive setting at the moment. But what's the neutral rate? I mean, there's no absolute right answer to this question because it's a bit like trying to get towards the horizon. The closer you get to it, you might never quite work out what the neutral rate is. But there's a range of models out there. And if you take a look at an average of the most respected models, the real neutral rate might be about 1%. So if you think about Australia's got an inflation of target of 2 to 3%, so call it 2.5%. That suggests that a neutral cash rate target should be about 3.5%. So at the moment we're at 4.35. That should be restrictive. It does seem to be. So yeah, I mean, look, a lot can change as we've seen in the last 4 years. In the short term, there could be, who knows, there could be another geopolitical event or supply chain disruption that sees interest rates going up. But most likely the next move is down towards the end of the year, I guess. But I guess if you're thinking from a bigger picture point of view, where's the neutral rate likely to be? Nobody knows for sure, but it feels like about 3.5 or somewhere down there. So we've in recent years got used to lower interest rates than that, but now we're higher. But maybe over the medium term, as a North Star, it might be useful to think about 3.5 being somewhere around neutral.
I love the ideas that when in these concepts in investing, when they seem to get more complex, you should probably take a more simple first principles approach to things. And that's a perfect illustration.
Definitely
of that,
for property. I think when you think about the way online media works, the more dramatic the headline, the more likely to get clicks and readers. But that's not really how you invest in property, especially residential. You might own a property for 30 years, so basing an investment decision on what's going to happen next week or next month actually probably isn't that important or relevant. It could even be a distraction. And you'd be better served, I think, to think about long-term fundamentals when making decisions, and that's buying or selling, instead of getting too sucked into the latest madcap predictions because they're always out there.
Well, it's also the same on my side of the fence with the stock market and businesses. It's exactly the same thing. And this is why I was always a little bit perplexed during COVID when people placed so much emphasis on this is the new normal. The RBA governor's just told us rates aren't going to change until 2025. Let's just go crazy. I think a lot of people were quick to blame, those Illuminati, the people that know at the top, right? When one look at a long-term interest rate chart, and you could get a sense that was statistically below average. And these are the types of rules, very simple frameworks I like to come back to with these things is you don't need to be this kind of a surgeon with precision in the short term to make really good long-term decisions with your wealth. It's about just having a broad understanding of how all of these levers move and at what times, and just basically never getting yourself in a position where you can severely hurt yourself. And we have unfortunately seen people in the last 2 or 3 years really get into sticky situations, whether it's in property, whether they're over leveraging their business, whether it's they're over leveraging their personal account through credit cards or what have you, excessive spending and these types of things. And that neutral rate, let's just call it a neutral rate, I see it more as a range of values. It's we're going to be generally correct rather than specifically right here. And that's the way I operate across all of the investing that I do, to be honest, Pete, because there's so many extraneous variables, there's so many things that could go wrong that we simply do not have the ability to predict. It's as simple as that. No one does. So just being generally correct here. And like you said, we can take things like we've got in our little Google sheet here, we've got the implied yield, like what is the market suggesting interest rates could do in 2024 in the next 9 months. Well, markets are predicting that we could see a couple of interest rate cuts. But would I be banking on that as a proven strategy, as something that I'm going to go and buy another property or get in ahead of the next bloke? No, because it doesn't tie into a very long-term strategy. Maybe that is the strategy. Maybe now is the time to pull the trigger. But for me, I'm not going to base it on one economic indicator or one prediction. There's another thing here, Pete, which is just the currency movements, which we should pay some lip service to. I do have a bet with my father-in-law for a pizza in Rome. I'm heading over there soon. That the euro would fall, and it seems to, against the Aussie dollar, it seems to have gone the other way. But the Australian dollar is currently around 65.2 cents. And for those of you that, depending on which time period you look at, what's the average? Well, it's probably closer to 70 to 75, somewhere in that range, let's say. Statistically speaking, just purely through the quantitative lens, it looks like the Australian dollar is kind of plumbing at lows in terms of its what we call a moving average. It's not technical analysis. It's just how we think about the cycles within cycles. So how the currency moves within broader movements. It's below average. It is at a period where we've seen some weakness recently. So the implications here are there's a lower Aussie dollar, imports become more expensive. Conversely, if you're investing, you might want to look at, say, hedging part of your portfolio. I can explain that in a bit, but it's just worth understanding that that's another lever which changes every day that affects other decisions that the RBA might make or authorities around the world. So 65.2 for the Aussie dollar, which is down a fair bit in the first quarter, so it's worth noting. Recession fears on the horizon, Pete. Anything to note there? Any headlines catching you out?
For Australia, well, I mean, in a sense, we are in a recession. If you think about it in per capita terms, the economy
Sure.
Per person has actually been negative over the past year, about 1% smaller. So, I mean, even though we're not in a recession because population growth last year was about 660,000, you know, if you look at it per capita, yeah, actually things are slowing down. But that's what the restrictive monetary policy settings are designed to do. So, yeah, I don't think there's a major risk of a technical recession. Certainly nothing in the immediate future. But as you said, things can always change pretty quickly. So, yeah, but generally, if you think as an investor, you want to be taking a medium to longer term view and not worrying too much about the next quarter or the one after that.
Mm. In terms of things like retail sales, you mentioned it before, retail spending. This is just trying to get a pulse on the business side of things and how people are, both their personal budgets and what the businesses are receiving. Is there anything of note from the quarter that has either spooked you or things that you've looked at and you've thought, well, maybe there's some pockets of weakness? Because this episode is about trying to understand those machinations and what we should be paying attention to. Is there anything there?
Well, it's been a funny sort of 4 years or so, really. So obviously we had a couple of periods where there were lockdowns and retail turnover just dropped really sharply. And then when we reopened, things spiked back again. So if you went back to 2020, we were spending about 28 billion on a monthly basis in terms of retail turnover. Today, it's running at about 35 or 36 billion. So it's a lot higher. But of course, a big chunk of that is actually an increase in prices and not volume. So yes, I think if you actually look since, say, October or November last year, there's been very little change in retail turnover despite higher prices. So the volumes are probably flat or down a bit over the past 3, 6, 9 months. So yeah, people are tightening their belts, and that's what you'd expect. We've had mortgage rates have obviously gone up very sharply, and even now there are still people whose mortgages are resetting from 2% fixed rates to 6 maybe. So that's going to sort of curtail household spending. And don't forget, that's not just a one-off event. That's an ongoing recurring payment. So it does take a bit of time for these interest rate hikes to feed the way through the system. So the big picture is retail is soft. there's still a lot of wealth in Australia. And we certainly saw that over the Easter weekend. But yes, the sort of median household with a mortgage is definitely tightening their belts at the moment because interest rates are a lot higher than they were.
Yeah, and we're getting data from like savings and indicators and these types of things to show that households are feeling the squeeze on a ratio basis, how much they're saving each week or month or so on and so forth. We are starting to see people feeling that. And anecdotally, I think everyone that listens to this or watches this will have spoken to someone or felt it themselves recently, how their priorities have changed. I know on our Australian finance podcast, the community there is all about how do I maintain the habit of investing while I have reduced means. And the key thing is maintaining that habit. So if you aren't able to allocate, say, $1,000 this month on investing or 5,000, whatever your means may be, well, maybe you can do it with $50 or maybe you can do it with whatever and keep that habit because maybe we are in this restrictive cycle right now. And as your incomes increase and as Pete was alluding to earlier on, as maybe we see some moderation in interest rates or something like this, maybe things become a bit easier for you and you can maintain that habit. You will then be able to expand the amount that you save. So there were some final things we might talk about here just around financial markets. And we can see bond yields in Australia. I was just looking at the IAF ETF, which is the most popular bond ETF in the country. The yield is around about 4%. You look to the US, it's not far away either. So all of a sudden, Pete, and we could talk maybe a simple example of this is like a savings account. We had to look at ING term deposits. For 1 year, it's 4.9. No affiliation with ING, by the way, just letting you know. For a 2-year term deposit with ING, you can get 4.5%. Macquarie, Rabobank, all these other banks tend to have pretty good savings rates. Pretty compelling savings rates for effectively no risk with a government-backed term deposit or savings account. And with government bonds, Pete, you're looking at about 4%. This is great news for retirees.
It's something, yeah, there was a period there where you just couldn't get it, wasn't there? Like interest rates were basically zero. The yield to maturity on a bond portfolio is there's near zero, makes no difference. So yeah, I mean, if you're looking now for some ballast in your portfolio, some actual income, as you mentioned, some savings accounts, well, the amount that you put into some of those accounts might be capped. But if you get 5.5%, happy days. Inflation's now below that number. So you're not losing money, not eroding your capital. Bond portfolios are good or government bonds. So yeah, there's definitely ways now that you don't have to be all in stocks anymore. You can actually have a balanced portfolio. They can rebalance regularly. And yeah, on your previous points, how do you keep moving forward at a time when belts are being tightened? Well, I guess that's it. It's just a habit, isn't it? And this applies just as much in property. I think, in an ideal world, we'd all have like the perfect portfolio, but sometimes it's just not possible, but you just got to find ways to keep moving forward, I suppose, within the limitations of the budget that you do have. So yeah, I think it's, I mean, the traditional portfolios used to be more balanced, didn't they? 60-40 was the traditional balanced portfolio. Well, it's actually viable again for people to do that now that, as you mentioned, there's actual yield on offer and risk-free. So that's a big change from where things were only a few years ago.
Yeah, well, I've been chatting to a lot of our investors who invest with us, and we have 3 different strategies, Pete. And on the balance strategy, which is 50-50, obviously you get 50% in defensive, 50% in growth style assets. And it's interesting, those conversations about, well, what can you achieve from a quote unquote balanced portfolio? Well, we know the stock market in Australia is typically pretty reliable for 4% plus the franking credits that you mentioned before. So that's on the growth side. The US market tends to pay less in dividends, but it kind of makes up for it with growth. And then on the defensive side, you have cash and some bonds, and all of a sudden you're getting 4 or 5% in there. You're looking at a portfolio that should be able to grow and pay an income of, say, 4% pretty reliably over the next couple of years. And that's a really big relief for a lot of retirees and would-be retirees and people with assets, because all of a sudden you're getting a very good return from a portfolio that also should outpace inflation over time. Throw in some property there. There's a lot of people that, I think that 60-40 idea was just a very simple thing for academics, particularly in the US, to track. But obviously in Australia, there's this whole property complex, which is there's the 60-40 plus the property portfolio or plus the home. And that adds a different dynamic because, as we just mentioned before, maybe that plays a different role. It's not residential property for income. Maybe you need to supplement that in another way. But it's been a really interesting few months talking to investors because there's been this like mindset shift in terms of, well, all of a sudden I can get income and all of a sudden I don't need to take that much risk to do it. Whereas like you mentioned, you alluded to a phenomenon that was happening maybe 3 or 4 years ago, which was the past 2 decades saw falling interest rates to when bonds basically went to zero. And people just moved further and further and further down the risk curve to the point where retirees were in extremely risky portfolios. They were talking about venture capital at the dinner party, these types of crazy ideas. And nowadays they don't have to do that. So they can wind back on some of that risk and get some return, which is really, really respectable. Maybe I'll just throw out for stock market folks and people that are interested in this, year-to-date returns in 2024, for the S&P 500, this is the total returns, this is dividends plus capital growth, by the way. We're looking from Y charts suggesting it's 9.5% for the US market and 5.2% for the Aussie market. That doesn't include franking credits, of course. So if you ask anyone, my budget's pretty tight, I'm pretty stressed. Well, the stock market's gone up. Property prices across the board mostly have gone up. Interest rates have kind of plateaued. It's actually, if we can zoom out from the day-to-day, maybe the household budget is a bit stretched, but if we can zoom out, chances are your super fund's up, your net worth on paper's gone up thanks to property and thanks to shares. And all of a sudden, particularly retirees, I'll single out, are getting more income. So there are a lot of winners in this first quarter, Pete.
So the ABS, they're a quarter behind, but they put out the household wealth, finance and wealth figures for Australia. So for the December quarter, household wealth was up 2.8% and 7.8% over 2023. So as you said, if you zoom out, there's 10 trillion in residential property, there's 4 trillion in super, and there's about another 4 or so in currency and deposits and in the stock markets. So over 18 trillion in assets. Now we do have some debt as well, a few trillion there. But yeah, net worth in Australia, 15.7 trillion. So now if you went back to 2007, when the world ended, stock markets were very volatile on the downside, shall we say. And yeah, Australia's net worth went from about 6 trillion to 5.3 over that sort of GFC period. But today it's 15.7. So I think, don't want to get sucked into Warren Buffett quotes, but as Charlie Munger would have said, never interrupt compounding unnecessarily. Well, yes, we've seen, and the population grows over time, that's a part of it, but net worth has gone from 5.3 trillion to 15.7 at a time. And think about all of the doom and gloom articles you've read over that time. We've got superannuation fund balances at record highs, property prices, not everywhere, but overall record highs, stock markets are near enough record highs. So yes, wealth has never been higher. And yeah, there's challenges for sure, mortgage stress and things like that. But there's also now risk-free returns on offer. So yeah, look, there's always, the things are never completely perfect at any given point in time, but they're pretty bloody good for Australia compared to where things might have gone. If you think about with all the lockdowns and the uncertainty, I mean, who really knew what was going to happen? But Australia's come through in a pretty good state overall.
I love that summary, Pete. I think that I couldn't agree more. There are always winners and losers in an economy. And right now we are seeing people who are struggling to make ends meet, particularly if you're in the rental market. Pardon me, that's a really tricky situation, and it is going to require a lot of political will, probably more than anything else, to be honest. But as you go about your business, there are, the old kind of cliches, what you can control, your circle of control, your circle of influence, and what you can't control. It's about knowing what you can control each day, knowing what you can influence, but you may not be able to control, and the things that are completely outside of your control. Those include interest rates, inflation, currency, property prices, all those things that you simply cannot control. and differentiating those to what you can influence. Maybe your income, you don't have a direct control over that, but one of the things, the most important thing to do when you are just starting out or when you're trying to find your feet is, can you get a pay rise? Can you earn more and save more? Can you do that? That is the number one thing to do when you are starting out, because it doesn't matter what the stock market does, doesn't matter what property does, you will get a much higher return on your effort for focusing on your income and your savings rate. And then what you can control, well, we've got some control over our budgets. Obviously, rental prices may be a little bit outside of our control. They're in that influence bucket, but it starts with that framework and knowing what you can control, knowing what you can influence, and then knowing what is simply outside of your influence or control. Spend less time worrying about those and more time worrying about, how do I build wealth? How do I build habits? How do I earn more? If you do that, that is the formula for long-term wealth creation. So try and zoom out of the noise and zoom into the state of the markets. This episode that we will put out every quarter, if you like it, please let us know. Please write into Pete or I or anyone. There's a link in your show notes that says ask a question. You can use that to also give us feedback. We love hearing from you each and every week when we do podcast. Chris and Pete on the Australian Property Podcast every Sunday. Drew and myself on the Australian Investors Podcast every Saturday. We just absolutely love hearing from you. If you do want to work with Pete on property coaching or buyer's agency, there is a link in the show notes. You can get in contact with Pete and work with him one-on-one. He's an absolute legend of the circuit, and we are so grateful to have him contributing and hosting podcasts and doing all this sort of stuff. So, Pete, mate, it's always a pleasure when I get to chat to you. So thanks for doing this for the community, and thank you for everything you do each week. And have a great day. Enjoy that sunny weather.
Yeah, likewise, always enjoy our catch-ups, Owen. And hope to get down to Melbourne sometime soon, hopefully for a bit of football. So
let's do
I'll see
it
you in the flesh sometime in the near future.
Great. Thanks, mate. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.